Most people grow up believing that financial success comes from working harder, earning promotions, and saving whatever remains after taxes and bills drain their income. It is an honest path, but it is the path designed for workers, not for owners. Deep inside the world of finance, there exists a strategy that the wealthiest families have quietly used for decades, not to earn more, but to legally reduce what they owe and to expand their control over wealth without interruption. This method is not complicated, nor is it reserved only for geniuses or insiders. It is simply invisible, because most people are too busy working on the outside of the system to notice how the inside works. They assume that wealth is earned through effort, when in reality, the largest fortunes are preserved through structure. While ordinary people are taught to save money in bank accounts, the wealthy are taught to let assets grow untaxed, to borrow instead of sell, and to leave inherited value untouched by tax collectors. The strategy sounds strange, almost brutal in its honesty: buy, borrow, die. Although one word in that phrase makes people uneasy, it represents the most powerful legal loophole in modern economics, one that shifts wealth forward without ever breaking the law. Those who understand it stop chasing money and start positioning themselves in a system where money grows silently, protects itself, and becomes generational without being chopped apart by taxes along the way. The first step in the strategy seems simple: buy. Yet the meaning of buying is completely different for those who build wealth versus those who simply spend. Most people buy liabilities, cars that lose value, gadgets that become outdated, clothes that depreciate, entertainment that disappears the moment it's consumed. Rich families, on the other hand, target assets, and they select them with discipline. They invest in businesses, not just stocks, in properties that can produce income, in land that increases scarcity over time, in projects that generate cash flow even while they sleep. The wealthy don't think in terms of price. They think in terms of compounding. A luxury vehicle costs hundreds of thousands and never comes back. A rental property worth the same amount can return monthly cash flow for decades and still appreciate in value. Wealth is built not through comfort purchases, but through ownership in things that appreciate without effort. The true magic begins when the asset grows in value and nothing is sold. As long as the asset is not sold, taxes do not appear. An investment could rise by millions, yet no tax bill is triggered because no transaction has occurred. This is the opposite of how most people behave. The moment the average person's stocks rise a few hundred or a few $1,000s, they feel pressured to sell and take profit. They celebrate a small win, but unknowingly destroy the very engine that would have compounded into large wealth. By holding instead of selling, the wealthy avoid capital gains tax for as long as they refuse to liquidate their investments. They ignore crowd psychology and resist the temptation to cash out. While employees are taxed before they receive their paycheck, asset owners never get taxed until they sell, and the strategy only works when they never sell. Ownership is not about making money. It is about allowing money to grow uninterrupted. The most difficult part of this strategy is not mathematical, it is psychological. Wealth requires patience, and patience is a form of power most people never learn. Society trains individuals to seek immediate gratification, buy now, use now, upgrade soon, repeat endlessly. The reason the wealthy hold their assets is because they understand the value of time as a multiplier. Time is the engine that drives compounding, and compounding is what converts ordinary investments into extraordinary fortunes. Money grows faster than effort, but only when it is left alone. When someone invests then sells too quickly, they are like a farmer who plants seeds and then digs them up before they can grow. The wealthy treat their investments like trees. Left undisturbed, they eventually shade entire generations. They are not constantly checking the price of every stock. Instead, they are thinking decades ahead. They do not ask, how much profit can I take today? They ask, how much wealth will this produce if I never touch it? The rich avoid emotional decisions. They ignore panic selling. They avoid cashing out at temporary highs, and they understand deeply that real wealth comes not from maximizing transactions, but from minimizing them. They know that the tax system rewards stillness more than motion. The less you sell, the less you pay. The longer you hold, the greater your compounding advantage. This is why wealthy families teach patience as a financial skill, not as a personality trait. Holding is not passive, it is a calculated move to avoid losing wealth to taxes, fees, and impulsive decisions that weaken compounding. Wealth is rarely created by trading hours for money because time is limited and taxes constantly reduce what workers keep. A person can work hard their entire life, get promotions, earn higher salaries, and still struggle to build lasting financial security because wages are taxed first and invested later, which means growth always starts from what remains after deductions. On the other hand, wealth built from ownership begins before taxes and grows without constant interruption. This is why those who understand money focus on acquiring assets that produce value over time instead of relying only on income produced through labor. Ownership separates rich thinking from poor thinking. It shifts a person's effort from earning once to earning repeatedly from something they built or purchased a long time ago. Most people spend their money on things that lose value the moment they get them. A car starts depreciating the minute it leaves a showroom. A phone becomes outdated in months. Clothes fade, gadgets become useless, and luxuries never return money. These are called liabilities, not assets, because they take money out of your pocket. Meanwhile, assets generate cash or grow in price. Stocks pay dividends, real estate pays rent, businesses produce profits, and even digital assets or royalties can bring income long after the work has been done once. When someone buys an asset, they are planting a financial seed. If they protect it and let it grow, that seed multiplies into more seeds. People who stay poor usually eat the seed. People who build wealth plant it. The power of owning assets is that they free a person from needing to work forever. Even if someone has a high salary, they must keep showing up to continue earning. The moment they stop working, their income ends. Ownership breaks that dependency. Imagine receiving rent every month from a property, or profit shares every quarter from a company, or royalties from content created years ago. These earnings arrive regardless of one's daily efforts. That is the difference between income that is earned once and income that keeps returning because of something owned. True wealth is not measured by how much money someone earns, but by how long they can survive without working because their assets support them. Another overlooked element is how ownership amplifies one person's effort far beyond what they could achieve alone. A business owner benefits from the productivity of every employee. A shareholder benefits from the work of entire corporations. Real estate investors benefit from rising prices driven by market demand, not their personal labor. An asset works on behalf of its owner, building wealth even when they sleep. It is the closest thing to cloning one's time and effort. Instead of being limited to 24 hours a day, an investor multiplies their financial force by owning things that produce value without requiring their direct involvement. The system itself is structured to reward ownership. Workers are taxed before they invest, while investors can often grow wealth before paying any tax at all. That difference might seem small, but it changes everything. If someone invests after being taxed, their compounding shrinks. If someone receives growth before taxes, their compounding accelerates. The rules favor those who own assets because the economy depends on capital, business creation, and investments to grow. Whether someone agrees with the system or not, it will continue to benefit those who understand it. In the end, building wealth is about changing habits, choices, and priorities. Instead of asking how much do I earn, the better question is what do I own that earns for me? Salaries can make someone comfortable temporarily, but assets make someone financially free permanently. The first step to real wealth is deciding to stop working only for money and start letting money work for you. Most people misunderstand compounding because they only see it in bank accounts or savings plans where growth is slow and constantly interrupted. They invest a little, withdraw a little, panic when the market drops, celebrate small gains, then sell too early. Every time they sell, they reset the growth cycle. What they don't realize is that compounding needs two ingredients to reach its full potential: time and uninterrupted growth. If either one is missing, the power of compounding gets destroyed. The wealthy understand that selling an investment is not just about losing ownership, it's about interrupting a force that could have multiplied their wealth dramatically if left untouched for years or decades. Compounding is quiet and patient, but it rewards those who trust the process long enough. Here is where most people lose the game: taxes. When someone sells an investment for profit, taxes take a portion of that growth immediately. So not only does the person lose the investment's future potential by selling, they also shrink their remaining money because a percentage is taken away by tax authorities. That means the new amount they reinvest is smaller than what they originally had, slowing future compounding. The wealthy avoid this trap by simply not selling. They let their stocks, real estate, business shares, or other assets grow without triggering taxes. As long as they don't sell, they don't pay capital gains tax. Their wealth grows on paper without shrinking, and that paper growth eventually becomes massive over long periods of time. Compounding works like a snowball rolling downhill. If you never stop it, it keeps getting bigger at a faster CE. When growth is not taxed, compounding becomes a superpower. Imagine two people investing the same amount. One keeps selling and paying taxes every few years, while the other holds the investment for decades without selling. Even if both earn the same rate of return, the person who doesn't sell will end up far richer because none of their growth is interrupted or taxed along the way. This is the same logic behind retirement accounts or long-term funds, but the rich do it on a much larger scale by avoiding any sale of big assets for as long as possible. They understand that every sale weakens compounding and every tax payment slows their growth. So they choose to let their wealth grow untouched and let time do the heavy lifting. What makes compounding truly magical is not the first few years of growth, but what happens after growth has built up. Early compounding feels slow and boring because the returns are small at first. That is the stage where most people quit or sell thinking it's not working. But compounding is exponential, not linear. The major growth happens later when the investment has already multiplied several times. Selling early means giving up the stage where wealth explodes. The wealthy are not smarter because they choose better investments every time. They are smarter because they hold for longer and don't interrupt compounding at its most powerful stage. Their patience becomes profit. Furthermore, compounding does not just grow money. It creates freedom. When someone has assets growing continuously, they don't need to chase high salaries or constant side hustles. Their money is doing the work for them. This long-term mindset requires discipline, but it pays off more than daily effort ever could. Compounding rewards behavior more than skill. It doesn't care how educated someone is, how talented, how strong, or how hardworking. It only cares consistency and time. Anyone can benefit from compounding, but only a few let it run long enough to experience life-changing results. When people finally understand that compounding becomes most powerful when not interrupted, their perspective on wealth changes. They stop looking for fast profits and start looking for assets they can hold forever. They stop trying to time the market and instead choose to own a piece of it. They stop worrying about short-term fluctuations and start focusing on long-term accumulation. Compounding is not about getting rich quickly, it is about staying invested long enough to let the invisible force of time turn small seeds into a forest of wealth. Most people think borrowing money is a sign of weakness, something people do when they are broke or struggling. For wealthy families, borrowing has a completely different meaning. They borrow not because they need money, but because borrowing allows them to access cash without losing what they own. Instead of selling their investments to pay for homes, cars, vacations, or even large business expansions, they use their assets as collateral and borrow against them. This simple decision keeps their investments untouched and growing. To them, a loan is a tool, not a burden. It is a strategy to maintain ownership while still enjoying a lifestyle that looks expensive from the outside. As long as their investments continue to appreciate faster than the interest rate on the loan, they keep growing wealth without sacrificing anything. The key idea behind borrowing for the wealthy is that loans are not considered income. Income is taxed, but loans are not. When a person sells an asset, like a property or stock, they are forced to pay taxes on their profits. That reduces how much money they can reinvest. But when they borrow against that same asset, they get cash in hand and owe nothing to the government. meant at that moment. They're essentially accessing the value of their wealth without triggering a tax event. This system rewards people who hold on to their investments instead of selling them. It allows them to keep compounding their wealth while spending money freely. Meanwhile, middle-class individuals often do the complete opposite. They sell assets to afford things and then lose the future growth that asset could have provided. Borrowing against assets also gives the wealthy access to cheaper money than what most people experience. Because they own valuable assets, banks consider them low-risk borrowers. That means they can get interest rates far below what is offered to someone without assets. If a person owns millions of dollars in stocks or real estate, they can borrow at maybe 3% or 4%, while their investments continue to grow at 8%, 10%, or even higher during market booms. This gap between the interest rate they pay and the return they earn becomes profit. They spend money at a low cost, while their investments quietly pay them more than what the loan costs. It becomes a form of arbitrage, a financial backdoor where they live off borrowed money and let their wealth multiply at a faster pace. Another overlooked aspect of this strategy is that borrowing allows the wealthy to avoid breaking the compounding cycle. Once compounding is interrupted, it takes years to rebuild its power. Selling an investment doesn't just trigger taxes, it resets the entire growth timeline. Borrowing solves that problem entirely. When they borrow, they don't have to touch their investment principal. Their investments continue to produce dividends, rent, or appreciation, even as they use borrowed funds to live, invest, or expand. In many cases, the income from their investments is more than enough to pay the interest on the loan, so they live tax-free while their assets cover the cost of borrowing. Eventually, the debt can be strategically paid down or even passed on through legal structures, but during their lifetime, it works as a tax-free income machine. People who misunderstand debt look at this and think it is risky or irresponsible, but they don't realize that the wealthy borrow against income-producing assets, not depreciating items. Middle-class individuals borrow to buy liabilities like cars, furniture, or gadgets that lose value and provide no returns. The wealthy borrow against assets that grow or generate cash flow. Debt for ordinary consumers becomes a burden because their loans are tied to things that drain money. Debt for the wealthy becomes profitable because their loans are tied to things that create money. This difference, liabilities versus assets, separates harmful debt from strategic debt. At its core, borrowing against assets is a method of keeping control. It prevents the destruction of growth through taxes, allows investors to leverage the value of what they own, and enables them to expand their wealth while spending freely. It may look like magic from the outside, but it is simply a logical understanding of how money behaves inside the financial system. Once someone realizes loans are not just for the needy, and that borrowing can actually protect and expand wealth, they begin to see finance through an entirely new lens. The wealthy borrow to stay wealthy, not to survive. They let their assets work on their behalf, while they enjoy the benefits without losing ownership. It is the silent strategy that fuels luxury lifestyles without ever interrupting the future growth of their wealth. The step-up basis is the final stage of the rich person's strategy, and it is the part that transforms a lifetime of tax avoidance into a permanent advantage. Most people spend their entire life working, earning, paying income tax, saving a pour on, and then paying more taxes when they use those savings. They believe that when they die, whatever is left simply passes on to their children. But the truth is more complicated. For most people, assets they leave behind still carry tax burdens, and those taxes get paid when their heirs eventually sell what they inherited. However, those who understand how the wealth system works do not leave taxable gains behind. They leave assets that legally erase decades of tax liability the moment they die. This is the core power of the step-up basis law. It wipes out capital gains taxes on inherited assets, as if the growth over a lifetime never happened. To understand why this is so powerful, imagine someone who invests in a property, a stock portfolio, or a business when they are young. Over decades, that asset may increase in value by millions. If they sell it, the government takes a portion through capital gains tax. But if they never sell and instead pass it to their children, then the law resets the cost basis to the value at the time of death. This means the original profit, what could have been heavily taxed, is erased permanently. The heirs can sell the asset at its new value without owing tax on all the growth that occurred during the original owner's lifetime. This effectively makes dying a tax loophole, something only the wealthy know how to use properly because they have spent years building assets they never sell. They borrow against them, live off them, and then let those assets transfer tax-free to the next generation. Average people do not benefit from this because they rarely hold assets long enough or in large enough amounts for the step-up basis to matter. They often sell what they own in order to survive. They sell their stocks during recessions to pay bills. They sell their homes to upgrade. They sell investments whenever they need cash. Each sale resets growth and triggers taxes, shrinking their ability to build long-term wealth. Meanwhile, wealthier families never interrupt the compounding process. They only borrow against their assets, avoiding sale altogether. That is why the step-up advantage only works when someone keeps assets for decades without selling them. The wealthy understand this rule deeply. They build wealth strategically, not emotionally. They don't cash out to feel rich. They allow tax laws to work on their behalf. The most fascinating part of this tax rule is how it encourages generational wealth. Without a step-up basis, every generation would be taxed heavily every time assets changed hands. Over time, family fortunes would shrink. This rule essentially protects the rich from losing wealth to the tax system. It allows one generation to borrow and live on assets without selling, and then lets the next generation restart ownership with no tax baggage. The cycle continues. The heirs themselves can then repeat the same process, buy appreciating assets, never sell them, borrow to live, and pass the fortune on again. Wealth becomes almost permanent even when it changes owners. Many people look at this system and think it is unfair. They argue that only the rich benefit, and they are partially right. But fairness does not change how the system works. The government designed these laws to encourage investment and long-term ownership, because long-term ownership supports the economy more than short-term buying and selling. Those who study the rules and use them strategically create an advantage. Those who don't remain trapped in the cycle of earning, spending, selling, and losing to taxes. The step-up basis is not just a tax rule. It is the final move in a financial strategy built on patience, leverage, and disciplined investing. It is how wealth becomes legacy, not just income. It turns a lifetime of untaxed growth into a clean slate for the next generation, making wealth last far longer than a single lifetime.